Welcome to Chain Reaction by Capital Copilot, your daily dose of the latest in cryptocurrency news, market insights, and blockchain trends. Let's get started. Crypto markets just experienced their worst week since the FTX collapse in November 2022, with Bitcoin and Ethereum leading a brutal sell-off that wiped $390 billion from the total market capitalization. Bitcoin is currently trading around $62,393 after falling 17% this week, while Ethereum sits at $1,627 following a 22% decline. The catalyst was Friday's May jobs report, which showed the US economy added 172,000 jobs, more than double Wall Street's expected 80,000. This strong employment data crushed hopes for Federal Reserve interest rate cuts and raised fears of potential rate hikes instead. A resilient labor market means inflation remains sticky, giving the Fed little reason to ease monetary policy. Fed Governor Christopher Waller recently called rate cut talk crazy, and bond traders have shifted toward pricing in possible hikes by year-end. For Bitcoin and crypto assets that thrive on loose monetary conditions, this represents a fundamental headwind. Approximately $7 billion in leveraged positions were liquidated across digital assets this week. The sell-off accelerated after Michael Saylor's MicroStrategy disclosed its first Bitcoin sale in nearly 4 years, selling 32 BTC worth approximately $2.5 million. While the amount was small, it sparked concerns about potential future sales. Meanwhile, Bitcoin ETFs have seen record outflows as investors rotate capital toward artificial intelligence stocks and anticipated IPOs from OpenAI, Anthropic, and SpaceX. Ethereum is testing a critical 9-year golden triangle formation, with support at $1,950 representing the make-or-break level. As long as ETH holds above this threshold, the long-term bullish structure remains intact, with potential targets around $10,000. However, a breakdown below 1,950 would invalidate the entire formation. On the institutional front, Meta announced it will pay creators in USDC stablecoin across Colombia and the Philippines, expanding to over 160 countries by year-end. Meanwhile, America's largest banks including JP Morgan Chase, Bank of America, and Citigroup announced plans to launch a shared tokenized deposit network through the clearinghouse by the first half of 2027, enabling blockchain-based settlement to compete directly with stablecoins. In regulatory developments, Britain's Financial Conduct Authority placed Hyperliquid on its warning list on May 21st, citing unauthorized provision of financial services. The Clarity Act, key cryptocurrency legislation aimed at clarifying SEC and CFTC jurisdiction, now faces 60% approval odds according to Galaxy Digital's Alex Thorne, down from 75% due to a crowded Senate calendar. Looking ahead, analysts identify $60,000 as critical Bitcoin support. A sustained break below this level could expose BTC to declines toward $55,000 or $50,000, while reclaiming $74,000 to $75,000 would be needed to confirm bullish recovery. That's a wrap for today's edition of Chain Reaction by Capital Copilot. We hope you're feeling more informed and ready to navigate the cryptoverse. Until next time, keep your digital wallets ready.